I get asked all the time by veterans, how can I use the infinite banking concept? I can tell you this, veterans have kind of an unfair advantage when it comes to infinite banking, IBC, privatized banking, bank on yourself, whatever you want to call it. You guys as veterans have an unfair advantage, and rightfully so. I want to thank you for your service. If you are a veteran and watching this, I'm going to show you exactly how you can use the infinite banking concept to basically be a cheat code in life where you can have passive income in retirement. You can have tax-free income, which who wants to pay Uncle Sam more than they have to, right? If you are a veteran, you are going to get a ton of value from this video. If you're not a veteran and you know one, send this to them because this can help our veterans. Our veterans helped us. We wouldn't have the freedoms we have without you guys. So if you're a veteran, stay tuned to the end. You're going to learn exactly how you can have an increasing income that is tax-free for the rest of your life. If you're not a veteran, watch it and send it to someone who is a veteran. And make sure to subscribe to my channel if you haven't already. Hit the like, I'd appreciate it. I hate asking for it, but honestly, it really does help out the algorithm to help me get out to more people so I can help more people. So my name is Devin Burr. Let's go ahead and jump into exactly how veterans can do this. So if you are a veteran and you served our country and you have a disability, you get disability income. It is tax-free. As you know, the federal government, the VA pays you disability income and there's no taxes on it. If you have 100% disability, it's $4,000 a month. So that's tax-free money that just comes to you for serving our country and being disabled in the process. So what I'm going to go over in this video is how you can take that disability income that is tax-free and put it into a tax-free vehicle that is guaranteed to compound and grow tax-free. So, and you can use that vehicle to become your own bank, which is what I teach people how to do, is to become their own bank so that you no longer have to rely on regular banks. So you're going to take your disability income and you're going to start funding a properly structured whole life insurance policy. Now, before you just totally stop listening because I said whole life insurance, keep in mind, I'm not talking about off-the-shelf whole life insurance that Dave Ramsey talks about. I am talking about one that is structured for the living benefits, not for the death benefit. The death benefit is just, it's there. It's going to be there for sure. You're guaranteed to pass away. So when you do, your family is taken care of. But what it's built for is the cash value, something you can use 100% tax-free for whatever you want, no questions asked, and not interrupt the guaranteed compound growth of all of the money that you're putting into the policy. So I'm going to actually pull up an illustration on a 40-year-old healthy male, just normal health, nothing crazy. So it's going to be standard health rating, 40 years old. And his name is going to be Sergeant Stacks because he's a veteran, right? Sergeant Stacks is taking his disability income. He's funding in a properly structured whole life insurance policy, and we're going to use it for infinite banking. I'm going to first bring up the whiteboard, show you guys how the policy is structured, how the money grows. But then more importantly, I'm going to show you how to use it because the policy is just the vehicle. It's how you drive the vehicle that makes it valuable. So I'm going to show you the vehicle first, Sergeant Stacks' vehicle, and then how Sergeant Stacks is going to use it to become the bank, recapture money, become more wealthy, and how he's going to have a increasing income throughout his lifetime. So you're going to want to stick around for this. And again, if you get value, make sure to like the video and share it with your fellow vets. If you're not a vet, share it with all the ones that are vets. So let's go ahead and jump into the illustration on old Sergeant Stacks. All right, so as mentioned, I am going to show you an illustration on Sergeant Stacks. Sergeant Stacks is 40 years old. I have him at standard health, so nothing crazy. He's just regular average health. No tobacco, so he's not smoking, he's not chewing tobacco. He's a healthy average individual, 40 years old. His name is Sergeant Stacks, of course. Here's his policy. The way this is designed is again more for the cash value rather than the death benefit. So he's going to be putting in his disability checks. He's got $4,000 a month tax-free from the VA. He's going to fund the policy with that money and have instant liquidity from those premium deposits. That's how an infinite banking policy is structured. You put money in, you can instantly use the cash value because it's got cash value instantly. It's a specifically designed policy. So that's how his is designed. As you guys can see here, he's putting in $4,000 a month. So that is his disability income. It's tax-free. Policies grow 100% tax-free. So he's got tax-free money in a vehicle that grows tax-free. Pretty cool. So you'll see here that every year he's putting in 48,000 bucks. 4,000 times 12. Pretty simple math. So he's got 48 grand that goes in year one. His cash value at the end of the year, so this includes his dividend, is 39,000 and some change. So he put in 48, that's growing and compounding. He's got access to 39,000 of it. He can use that tax-free. So basically when you use a policy, you're borrowing from the insurance company and they're using your money as collateral. So your money's not being removed from the policy, which is good. That means that it keeps compounding and growing tax-free. So you're borrowing against it using the insurance company's money, and your money's sitting there compounding and growing tax-free. So again, 48,000 goes in year one. He's got access to 39. Because this never stops compounding and growing, year two, he's going to have access to more. So you can see, puts in 4,000 a month in year two. Again, this is tax-free money that he gets. It's passive income from the VA because he served our country and he became disabled in the process. So 4,000 a month is 48 grand a year. Look at this. His cash value grows in year two by almost 45,000 bucks. So year one, he put in 48,000. He had access to 39. Year two puts in 48,000. It grows by almost 45. So he's got access to like 84,000 bucks in year two. And that's because it never stopped compounding and growing all the money he was putting in every month, even if he used the cash value, which is cool. So I'm going to get into how he would use the cash value. I just want you to understand how the policy works. Money goes in, it's guaranteed to compound and grow, tax-free. More you put in, the more it grows. The more you put in, the more you can use. I'm just using the example of Sergeant Stacks putting in just his 4,000 a month in disability income. Every single year, because this money never stops growing, he's guaranteed to have access to more the next year. So year three puts in the 48,000 throughout the year. Policy's value grows, the cash value, by 47. He's almost got access to dollar for dollar what he put in that year. That's only 3 years in. He's only 43 years old. He's a young man still. Now, year four puts in the 48,000. It grows by almost 50, 49,939 bucks. That means that this year he put in 48 grand. He's got access to more than what he put in because, again, all of this never stopped compounding and growing. 100% tax-free, even if he used the cash value. So you'll see when I get into the next slides how to use the cash value to become your own bank. And you'll understand now that this is why it works. All this money never stops compounding and growing, even if you use the cash value. Really, really cool. Another cool part about it is all this money is protected from lawsuits and judgments in most states. So it's the safest place for his money to go. No one can take it. It's protected there. And it gets his family a death benefit. He's going to pass away at some point. So if he passed away the first year, death benefit, as you can see, is about 802,000 bucks. It grows as he gets older. So as he's more likely to pass away, his family gets a bigger death benefit payout. If he lives until 50, at 50 years old, it's doubled. He's got almost 1.7 million in a death benefit. It's not built for that. That's the cherry on top. It's built for the liquidity of what he's putting in. As you can see, by year 4, puts in 48 grand, has access to basically 50. Year 5 puts in 48, it grows by 53. Year 6 puts in 48, it grows by 56. It just keeps getting bigger and bigger and bigger because the compound growth is never interrupted. Now, again, the reason for that, he's not removing this money. If he uses his policy on a policy loan, he's borrowing the insurance company's money. They're using this money as collateral to give him a loan of his cash value. The cash value is basically just an advance of the future death benefit. So he could use the cash value, never pay it back, and all that's going to happen is the death benefit's going to lower. So when he passes away, his family would get less because he didn't pay back the policy loan. He has total control, which is amazing. So that's the policy for Sergeant Stacks. You can see how it's designed, why it compounds and grows tax-free, how it grows, how much it grows year by year. But let's jump into how to use it, because this is going to happen regardless. This growth that happens each and every year, this is going to happen regardless if he uses the policy or not. So if he just puts his money into this, it's just a really, really good and safe savings account. That's it, with an extra death benefit on the side. Using it is what makes it really, really a cheat code. So let's jump into that, and that way you can get a full understanding. After that, I'm going to show you exactly how he uses this as a increasing income the older he gets. Let's check it out. All right, so Sergeant Stacks has the greatest life insurance policy known to man. He's got the best policy he can possibly have, but if he doesn't know how to use it, it's just a glorified savings account, right? Let me show you exactly how Sergeant Stacks can use that savings account, that savings vehicle, to become his own bank. Check this out. So he's putting his $4,000 of his disability income that's tax-free into the policy. It grows tax-free. Remember, the first year, if you remember on the last slide, is it basically gave him $39,000 in cash value the first year. So he puts in his $4,000 a month. He lets it build up for the year. He's got $39,000 at the end of the year. He can use it before then, but I'm just giving you an example of how to use the policy. So $39,000 at the end of the year. Let's say he's got a car loan. He's got a car, he's paying on it every month. He wants to take that policy, use it to become his own bank, and pay the car off. Amazing way to use infinite banking. So check this out. He takes a policy loan from his policy, which again is just an advance of the future death benefit. So he takes it, pays off the car. Now, the car loan, and I did the math on this, you guys can cross-check it in the comments. Please let me know if I did it wrong. I know I didn't, because calculators, they don't mess up. So it was basically a car loan for $55,000 for 6 years at 7% interest. By the second year, so 4 years left, he'd have about $39,000 as a balance. And his payment is $937.70 per month. So he was paying that every single month without fail to the bank. All he's going to do now, since he pays it off with his policy, he's just going to take that $937 that he used to lose to the bank, and he's going to pay it back to his policy. So he's going to pay back the policy loan. Because remember, he paid off the bank. He paid off the bank for the truck. He was paying them every single month without fail, $937.70. Now, he can just simply take that exact same amount that he used to pay them and just put it back into his policy. Remember, in his policy, it's protected from lawsuits and judgments. When he pays the bank, that $937 is gone forever. He'll never get it back. and it'll never get its ability to earn him money ever again. By simply taking it and putting it back into the policy, he's got it in his control now. As soon as it goes back there, he could use it again if he needed to. 937 bucks. It's sitting in the policy now in the form of cash value. So it's safer there. It's going into a place where it's going to compound and grow tax-free. And check this out. He's going to get back every single dollar of that 39,000 because this 937 and 70 cents, it includes principal and interest. 39,000 is the principal. The interest is about $6,009. So over 4 years, 48 payments, that's how many he had left to the bank. He's just going to pay the same thing back to his policy, his bank. He's going to pay 48 payments of $937.70, which comes out to $45,009.60. He's going to get back the entire $39,000 plus the interest he would have paid the bank. He's keeping more of his money. It's not about how much money you make. It is about how much you can keep. The more you can keep and the more you can have it compound and grow, especially if it's tax-free and if it's guaranteed to compound and grow, the wealthier you're going to get. It's inevitable. It just takes time. So that's how he's going to actually recapture money on his car, by becoming the bank. So check this out. That's year one. Okay, so year one, sorry guys, so year one, he recaptures the money. Year two, he's going to put his $4,000 a month into the policy like he is every single month. Remember, year two, the cash value grew by almost $45,000. So $44,845. It grew more than it did the year before. That's how they're designed. It's guaranteed to happen. He's recapturing all this money into his policy that he used to give away. $937.70. That comes out to $11,252.40. So this plus the cash value means inside of his policy, he's got access to $56,097.40 by simply recapturing the money on the car. He was losing that forever. Now he's no longer losing it. It's going into a place that is protected from lawsuits and judgments and that is guaranteed to compound and grow. So that's year two. Now what he's going to do, let's say he's got no debt. He has no more debt. The car was the only debt. He's now going to take this $56,000 and let's say he does an investment. Now this is not investment advice. This is, again, just an example of how old Sergeant Stacks would become his own bank. So he's going to take the $56,000 and he's going to become a private lender. He's going to lend that money to somebody like a real estate investor. You can do this all day long, guys. I have done this several times and you can get a really good return on your money. You can get 10, 12, 15. I've even gotten 18% by being a private lender. So what Sergeant Stacks is going to do, he's going to lend that $56,000 at 12% interest. So what that means, year three, his $4,000 disability income is going to go into his policy. He's going to have $47,318 in growth in year three. Remember, it just keeps getting bigger and bigger and bigger. So $47,318. He's still recapturing the car payments. Remember, the car had 4 years left. This is the second year of him recapturing his payments. So $11,252.40 that he used to give away and lose forever is going back to his policy now. Plus, he's got his private loan out there, the $56,000. At 12%, that would yield him $6,720 in income. So he's got these three things in his policy now. He's going to take that income and just put it back into his policy. Remember, it's the safest place for money to sit, protected from lawsuits and judgments. So altogether in year three, now he's got access to $65,290.40. You guys see how this just keeps getting better and better and better the more you use the policy to be your own bank. How can you be your own bank? You can pay debts off that you owe to outside creditors. Those debts include interest. So if you simply pay them off and then you take what you used to pay them and pay it back to your policy, you are guaranteeing yourself a return of whatever that interest rate was. If you're paying 10, 12, 13, 15, 20%, 25% on a credit card, if you pay it off with your policy and pay back to the policy what you used to pay the bank, you're getting the interest you used to pay them. You're literally guaranteeing yourself that return on your money. It's crazy by simply just being the bank. You can buy things that you would normally buy from a bank: cars, houses, boats. As you can see, he's getting more and more money into his banking system the longer he has it. So the longer he has it, the more he can use it for. He can start financing cars. He can start, taking trips using his cash value. He could buy a house and be the bank for that. You can start becoming the bank through your own debts and expenses. Then, if you don't have any debts and expenses, remember, he paid off his only debt. He now has the money that he can go invest and make more money. So he's making money in the policy. It's compounding and growing, tax-free, and he's making money outside of the policy at the exact same time. Super cool. Now, let's jump into how he has an ever-increasing income the older he gets. This is mind-blowing to me because the fact that his disability income is already tax-free. This is just more tax-free income. Check this out. So when he's 60 years old, let's say, so remember, he's 40 years old when he starts this policy. So 20 years from now, he's still going to get his disability income. When you're disabled as a vet, you get that income for the rest of your life. It's tax-free for the rest of your life as a disabled veteran. So at 60 years old, at that time, his policy is max funded, basically. He can't keep putting in $48,000 a year. That's just the way they're designed. If you put in too much, it becomes taxable. So you don't want that. You don't want it to be taxable. So at year 20, he can't put in 48,000 anymore. He can only put in 9,600. So he's going to put in 9,600 bucks. The cash value grows that year by almost $69,000. So what he's going to do is he's going to take a loan of that money. Loans aren't taxed. He's going to take a loan from the insurance company for 69,000 bucks and use it as tax-free income. Loans are not taxed. He's never going to pay this loan back. He doesn't have to. The insurance company will never ask him to pay the loan back because it's just an advance of the future death benefit. I'm going to show you guys how the death benefit keeps getting bigger. Crazy. So 9,600 bucks goes into the policy. It grows by 69,000. That is insane right there. Just 20 years in. Plus, he's still got 38,400 bucks. Remember, he's paying his premiums with his VA disability. So 9,600 bucks goes in. He's still got 38,400 bucks of his disability income. So these two numbers together is $107,325 of tax-free passive income at 60 years old. And it just keeps getting better. At 65, he puts in 9,600 bucks. Cash value grows by almost 86,000. Insane. That's just 5 years later, and look how much more growth there is. The growth never stops. It's uninterrupted. He's still got 38,400 left over from his disability checks, because remember, he put in 9,600 of it here. So these two numbers together is 124,015 bucks. That is his tax-free retirement income that is passive. Just keeps getting better. When he's 70, puts in 9,600 bucks, the cash value grows by $106,000. Plus he's got 38,400 left over from his disability income. The guy has $144,584 of tax-free passive income that will keep getting bigger the longer he lives. And check this out. Even if, let's say, he passed away this year, by this time in his policy, his death benefit is up to $3 million. So he can never pay these policy loans back. What's going to happen is when he passes away, his family is going to get the $3 million death benefit. Remember, it started at $800,000. It's up to $3 million now. They're going to get the $3 million less the policy loans that he didn't pay back. He's never going to pay these back. That's the strategy. That's his retirement income. He's just going to use his death benefit while he's alive as passive income. And as the death benefit keeps getting bigger, he can just, again, never pay it back. He's never going to outlive that death benefit. That's the way it's designed. So guys, I hope you got a ton of value from this. This is a cheat code. If you are a veteran, you need to be taking advantage of this. You need to be taking advantage of it right away. Again, it's not how much money you make. It is about how much of it you can keep. This is a way to keep every last dollar and have it never stop compounding and growing for you and your family for the rest of your life. So if you're ready to take back control of your money and become your own bank and learn more about this, definitely check out the description in this video. I have a free training that's, it goes really in depth on how these policies work and how you can really just learn more about the whole concept. Register for that training video, watch it till the end. At the end, you can schedule a call so me and my team can help you become your own bank. We don't sell policies, we don't sell life insurance, we teach a concept. We're licensed, so if you want to do the concept, we can set the policy up for you, but we do not sell. You'll never get salesy people on the other line with me and my company. So that being said, if you want to take back control of your money, check out the description in this video. Check out the video, register for it, watch it to the end, and schedule a call. If you liked this video, you're going to love this one. Check that out. Until next time, I love you guys. Peace.